Hey, welcome to another monthly Be the Bank Note Investing broadcast. I'm Justin Bogard, and today is Valentine's Day, and yes, we are going to be recording live. I have Chris Seveney, Jamie Batemen, and Jay Redding that are going to be on the show today. We're going to be talking about kind of what's going on with the residential mortgage market today. We're going to talk about commercial real estate business and then some raising private capital. So if you have any questions, we want you to make sure that you chime in to the chats so we can answer them live on the call. So stay tuned. What's up, my dudes? And I am blurry. What's going on here? Wow. I am a figment of your imagination. Wow. What's going on here? All right. I'm Blurface. Here. This is better.
Did you also call me 7T, not 7E? Sound like you threw a little T in there. So.
Oh, I'm sorry.
That's okay.
So Chris is 7T. I mean, he's with 7E. Oh, there we go. Happy Valentine's Day, everybody.
Thank you.
Happy Valentine's Day.
Yeah.
I was going to get you guys something, but you know,
but you didn't.
I got busy. Things happen, you know.
Jamie's worried, like, uh-oh, what's Chris going to say on Valentine's Day?
I'm worried about that every day.
Well, thanks for being on the show today, guys.
Hey, just remember, you can always treat your significant other early, but don't be late.
That's
that
true.
Sounds like speaking from experience. I don't know.
Yes.
Kind of like your mortgage payment. Pay it early.
Yeah, that works.
It only benefits you if you pay early.
That's called 40 years of marriage. So
there's some sage advice from Mr. Jay Redding.
That was a bonus. There you go. You don't have to pay anything for that bonus.
Well, Jay, let's start with you over there on my screen here. You're in the upper corner. So where are you from and where are you at?
Based out of Fort Wayne, Indiana. Just a stone's throw away from you, my man.
I know we can probably bump a volleyball back and forth to each other.
Yeah.
Pretty close. Not that close, but we're relative to, where Jamie and Chris are compared to us. So,
yes.
So Chris, where are you at?
I am in Northern Virginia, right outside Washington, D.C.
All right. Jamie?
Stone's throw from Jamie, but we never visit each other.
No.
You never do?
No. I mean, we've met before, but not in our hometowns. Yeah, I'm an hour and a half to 3 hours, depending on traffic, but I guess northeast outside of Baltimore, Maryland. So DC, it's like people think I live right next to DC, and it may as well be Indiana.
You live next to the White House?
It doesn't matter. Even if you're like a few miles away, it's still going to take you an hour.
It's still going to take you an hour. Yeah.
495. Exactly.
That's funny. Yeah, Jay and I only run into each other at events, really. We never intentionally even meet. That's funny how you guys in the same situation.
I mean, Chris and I didn't meet for 4 years. I mean, we were co-fund managers and had JVs going together, and then we started a podcast. Yeah, weekly podcast, and then a servicing company, and took us 4 years until we actually met in person.
That's crazy.
COVID was part of that too, but
I had met Chris in person until I think it was in 2023 at a Note Expo event.
At Note Expo, yeah, that's where I met you, Chris. That's the first time. Jamie, I've yet to meet you in person.
No, hopefully this year.
Okay, awesome.
All right, we're going to see Jamie out and about. All right, guys, I'm going to flip it over to the PowerPoint here. Give me just a second. We can start in on the conversations for today. All right, this broadcast would not be possible without the four of us reaching into our wallets and paying heavily for some amazing graphics and artwork here. No, I'm just kidding. They paid nothing. They only shook my hand and said, "May I be on?" I said, "Yeah, sure, why not?" I'm a famous YouTuber now. So American Note Buyers, that's my company. You can reach out to me at investors@ambfunds.com. Like the rest of the guys on the show today, we're note investors. We have a small fund, and we pretty much are just buying seller finance paper right now, primarily performing first lien, and that's really kind of our jam. Cassidy, you're up.
Yeah. We basically raise capital and we buy and create mortgage notes, primarily on single family homes. And we essentially seller finance to people who fall just outside the bank qualifying guidelines, all right, to help them to be able to purchase a home with a large down payment. So that's what we do.
All right. Chris.
And we run a fund that also invests, primarily we focus on the non-performing loan space. So that's our focus now is raising money for that offering.
All right. Mr. Batemen.
Yeah, so run a loan servicing company, BIFI Loan Servicing. I am the CEO of BIFI, and I also do run a couple of smaller note funds. One is non-performing, and one is more of a re-performing. Again, first lien is my wheelhouse.
Any of you guys do seconds?
I've dabbled.
Yeah,
Have not.
I've not done a second.
And we've also, I'll say bought some that were more like bridge style loans. But I mean, primarily, the first is our bread and butter as well.
Yeah. All right.
We will buy a second, but we'll pay off the first.
Makes
sense.
It
becomes the first.
Ooh, interesting.
Along the lines of what we all do, which is very, very common, but also a little bit of a different lane. We each have our own kind of podcast that we do as well. Mine is called Be the Bank. If you've watched the show before, you definitely know it because I talk about it all the time. And we're on season 6 right now of Be the Bank. We've had several iterations of it, but basically it's just conversation, debatable topics, just centered around real estate, mainly in the note investing community. All three of these guys on here I've actually interviewed and had on for this 6th season that just started. So Jamie's episode hasn't released yet, but it has been recorded. So check out next Wednesday, right, Jamie's? It's going to be released.
Yep.
So Jay, go ahead and talk about yours.
Yeah, we do last Thursday of every month from 12 to 1 Eastern time. We do a note talks with Kyle and Jay, and it's a Zoom call. It's just a very open forum where we talk all things notes. It's we always have something prepared, but it's basically driven by the audience's questions. All right, and we kind of go from that. We review we review deals that we're working on, or something that we have purchased, or why we didn't purchase something, or something along that line. So that's what we do.
Cool. All right, Chris.
Wow, I got like the big banner logo compared to Be the Bank.
Yeah, because you got the amateur guy on here doing graphics. So.
I'm sorry.
Chris takes money for the sponsorship.
Yeah. So my podcast is Creating Wealth Simplified. And actually just recorded earlier this week a new episode where kind of rebranding it to going back to, say, the old school, where I used to have a podcast called Good Deeds Note Investing and provide a lot of education content on note investing. And with Creating Wealth Simplified, that's what we're focused on. 2 components now. We're going to be alternating between diving deep into note investing, sharing case studies, and then also do another segment on people, if you're a general partner, limited partner, due diligence and understanding, especially in today's environment of the risk involved with investments. We're going to be talking a lot about that as well.
Absolutely. Jamie?
So you looking for co-hosts, Chris?
So I actually have 2. So
just kidding. Chris and I used to co-host the Good Deeds Note Investing podcast, and before that, it was Gail Greenberg that started it with Chris. But anyway, my podcast is actually a little bit less. We do focus on notes and real estate some, but it's more tailored to the entrepreneur, and it's more human focused than most podcasts. And it's called From Adversity to Abundance. We just hit episode 100. A couple days ago, yesterday, and Shantae Duffy was featured on that episode, and that was largely about BIFI loan servicing. So I want to plug that episode 100 of From Adversity to Abundance. It's a fun. It's fun. It's my passion project. I love it. I learn a lot. It's and it's a little bit different than your typical note investing podcast.
Doesn't it? It amazes me when I look back and see how many podcast episodes I've done. It's like, over 100 as well. But it's like it went by so fast. It's like I did 100 episodes already. Like I felt like I just did a few.
Absolutely.
I was literally
just having fun.
I was literally just on a call and we were, forecasting, doing pro forma that goes out to like 2028 and 2029. And, we're like, wow, that's going to feel like tomorrow. And I'm like, yeah, COVID just felt like it was like not too far ago. And that was 2020.
Just yesterday.
That was 4 years ago. Like, oh my Lord.
Yeah. It's hard to believe. Yeah.
We're still feeling the effects of it.
Yeah. There seems to be I don't know, Jay, where you're at and the rest of you guys, if you're feeling the same thing, but there seems to be like a little COVID outbreak going on around where I'm at. So I'm staying indoors, staying away from it. I'm scared.
I'm pretty much from my home to my office. So that's pretty much it right now.
All right. The first topic of conversation today is going to be about the Mortgage Monitor update. This is something that I kind of pay attention to a lot. I haven't seen one come out in a while because they skipped December, I think just for the holiday reasons for their employees. But ICE is the rebranding of their company now. And so they have this really cool data that comes out and talks about just like the mortgages in general that are on residential homes across the U.S. from all the big players that they just record information about it. And then the chart I like to see the most is what I like to show, because I feel like the opposite is out there in social media so much in mainstream. I don't know if you guys agree with that, but they're saying how things are looking bad and looking bleak and looking, with foreclosures. And I keep looking at this chart and I keep seeing the blue line just kind of dipping way below what normal is. And right now the national delinquency rate is 3.57%. And it's been hovering, well under 4% for a while. I mean, I would say probably 2.5 years, it looks like from this chart, 2 years. So from your guys' perspective, do you also see headlines out there that say like, hey, the doom and gloom is coming and foreclosures are inevitable and that such? Anybody can throw in there.
I mean, I've seen mixed. I've seen articles that say, "Oh, it's increasing." Then articles say that it's at all-time lows. And I think part of it is to understand the difference between also delinquency and foreclosure, because it's rare that you're seeing foreclosures now because people have so much equity that they're filing bankruptcy. And how is bankruptcy treated? And that's one thing I tell people to look for as well, is you look at delinquency, but also look at that bankruptcy rate. And one thing I'll just mention to note investors as well is it's at 3.5%. Remember, it's a $13 trillion industry. So that means there's $500 billion worth of loans that are floating out there that are non-performing.
Pretty big number when you think about it.
And what if they start reperforming at 3%?
That's a problem if you bought it.
Yeah, that is.
That's why we don't buy 3% loans.
I'm not interested in that.
Well, speaking of that topic, do any of you think that we'll ever see a 3% rate in our lifetime?
Well, if you look back, I mean, I've seen some data. If you look past I think the last 50 or 75 years, the average interest rate's like 7.7%. What we have seen in the last few years has been an anomaly. All right. If you go back to, I'm trying to think, I'll say back to in my early years, back in the late 70s to 80s, when it was at 17, 18%, I actually do remember those days. And if you look at the trend lines, they've gradually, although there's been bumps along the way, those have gradually gone consistently down, over the years. But the average is 7.7, and it's like this is very reasonable where we're at. It's just that everybody got drunk on the low interest rate, honestly, and so much money being pushed into the system. What's going to happen? Inflation's going to happen. It has no choice about it in that respect. So it's a recalibration that everybody's got to get used to.
I got so used to the rates being so low when I started seeing it below 4%, and I saw them dip like below 3%, and was like, oh my God. Then I remembered like my first house, what was my mortgage rate? I think it was 6.25. That was like in 2004 or something. I was going, oh my God. Like, I'm spoiled now. That's really good right now. Right.
My mother and father, I remember in 2001, I bought my first house and it was 6%. And you're like, lock that in, lock that in. I'm curious. So, I'd like to ask everyone, what has been the lowest interest rate you've had on a property?
That's a really good question.
Hmm.
And we have a guest. Looks like Chris disappeared for a minute. Wendy Taylor says hello from Indiana. Hi, Wendy. Thanks for
Hi, Wendy.
joining our show.
So we had a 7-year adjustable on the house after we built it. We built it and then refinanced it a year later. It was at 2.5%.
Oh my
For
gosh.
6 of the 7 years. And when we refinanced it in year 6, that was in 2021. So our rate is at 3%.
Yeah, I
So-
had on our primary residence, they had a 10-10-10 through the credit union. It was 10 years first 10 years were 2.25%. And then it jumped to 4.25 and then 6.25, but I never let it get that high.
Yeah, if anybody listening out there right now live or watching the replay, whatever rate that you've seen that you've had the lowest, like Chris said, that'd be kind of interesting to see. So,
Yeah.
Jamie, did you have any comments about this?
Well, I was going to say the one, your question about headlines, I do recall a headline a couple of weeks ago where people were, I think it was on LinkedIn, and somebody posted the article saying this is misleading. And the headline was about the spike in foreclosures, but which was factual compared to, 6 months prior or whatever it was, but it's still, if you zoom out far enough, very, very low.
Mhm.
So fear sells, and that those
Yeah.
headlines get clicks, but in the grand scheme of things, it's super low. So you've got to actually read the full article, not
Yeah.
just read the headline.
All right, another chart that I grabbed off the report was the delinquency rate of first lien mortgages by the product. So the black line there is the FHA, the lightest gray is VA, the portfolio is the blue, and then the GSE is like, I guess what I call the sea green. But you can obviously see which loans take the borrowers with the most shaky credit there,
Mhm.
the FHA loans. So that kind of
The least
depicts
amount of down
exactly
payment.
what's that,
And the least amount of down payment.
if any,
Yeah,
down
it
payment,
shouldn't
right?
be- it shouldn't be any surprise at all.
Yeah. It's not.
So
But what I do like to see about the chart is that the GSEs and the portfolio paper, it kind of tailed off, and it kind of is still trending like kind of in a downward direction for the most part, which is good for delinquency. So it tells me that the underwriting is really good for that type of paper. And the FHA, I mean, obviously we need it because people, need to have a home and get some government assistance. But obviously there is a big risk to it, which is why the PMI is on that as well. So.
mhm.
Lesson learned for people who do seller financing. Look at this chart and understand why it's important to get a large, decent down payment.
Ding, ding, ding.
Ding, ding, ding. Absolutely, Chris. Cannot say that enough.
Yeah. Jamie, do you have any thoughts about this one?
Nothing to add.
Pretty self-explanatory, right?
Yeah.
Very fun. You're a fun guy today. All right. Yeah. Number and share of underwater mortgages. So we all tease each other, guys. We all know each other. It's all good fun.
Always
thought
have
this-
a little banter. Have a little
That's right.
banter here.
This chart was pretty cool because I look at it and it just reminds me of how bad it was, 12, 13 years ago versus what it is today. Just to put things in perspective, like Jamie said about the article that he saw, clickbait material that says the sky is falling, the sky is falling. Well, guess what? This is nothing compared to what it was, 12, 15 years ago. So as you can see, the amount of percentage of mortgages that were underwater versus what they are today, it's nothing. I can't tell. I'm guessing this is like maybe 750,000 at the very end there in Q4 of 2023 that are underwater. But it's not surprising, right? Because we've been in an environment that's appreciated like crazy since right before COVID.
Yeah.
One of the
sense.
things during that era with the foreclosures, these were underwater loans. I mean, there was no equity. If people are getting foreclosed now, there's typically equity, and there's ways of being able to get out, either selling the property and being able to move on. So a lot of these foreclosures are what I would call equity foreclosures at this point.
Well, this chart is focused on underwater mortgages. Go ahead, Jamie.
Yeah. Well, to Chris's point earlier, that's why we're seeing more bankruptcies, because people aren't going to walk away from 50 to 100 grand or more in equity, right? Yeah. So, and overall transactions have slowed considerably, right, across the real estate market. So people's property values have gone way up, but they're stuck because interest rates are so high. They can't go refinance out of it. They can't go buy a new house because property values are high and mortgage rates are high. So it's costs more to buy that new house. So there's just been this standstill with equity locked in the properties.
Let's quickly talk about the how. How do they get underwater with this appreciation cycle?
So I'll say I'm curious what this is going to look like in 2026 for all the people who bought in 21 and 22.
Yeah.
But how they get underwater is, and we've seen this on some of the seconds that we bought. People will take a home equity line of credit, and a bank will offer up to like 90% loan to value or 100% loan to value, or say 90. But then they do what's called a desktop appraisal. Whereas they're just like, okay, we think this house is worth 300,000, but they don't realize that the person's living in a house that's half renovated or ripped apart or needs 50,000 in repairs. They'll take out that money. Say they're 270 out of 300. They'll go pay off their credit card debt, rack up that credit card debt again, default, and then realize, oh, my house is actually only worth 225 because it needs all this work, and that lender really didn't do their due diligence. That's what we've seen.
So I should have put this up here because obviously it's just gonna be me talking and I don't have any proof by this, but I saw something on, I think it was LinkedIn today. Somebody had a really cool post about the US credit card debt. And it showed like around the time when interest rates went like way down, you saw the credit card like amounts go like way down. I want to say it was like, let's throw out a number like 750 billion or something like that, or 500 billion in credit card debt. And then within a few years after, appreciation and people like Chris was saying, put it on their credit card, now it's like well over like a $1.5 trillion of just credit card debt. So in like a couple of years, it's like, doubled.
Well, COVID, basically, people couldn't go spend money really. And there was PPP and 47 other government programs that were throwing money at people. So people are like, well, I can't spend it. Well, let me pay down my credit card. So that's where I know it's over $1 trillion now, I think, isn't it?
Yeah, I want to say it's like 1.1 or 1. I think it's a 1.5. I didn't mean that. Like 1.1.
Yeah, and the amount of savings has gone significantly down as well, which makes sense. I think it was a lot of free money printed, and on an individual or family level basis, generally speaking, people don't have the best, personal finance habits, and we're in a consumer economy. So here we are.
I think there's another factor in here that I don't know how much it plays, but I believe it does play just from what we see within our own portfolio of rentals. And that is, all right, we've had a tremendous amount of inflation, even though the Feds, all right, saying we're leveling out, the damage is already done. All right, the prices of everything just go and look at anything. Obviously, the prices have accelerated tremendously, but wages haven't increased at the same rate as far as what everything else has. And as a result, I think people are getting squeezed more and more now. All right, that dollar does not go as far in normal everyday consumer goods as it once did, and the wages just have not kept up with that. Nor have the rents. The rents have increased, but nor have, from our standpoint, have we seen the rents increase to the same level as what the expenses and the cost of labor, materials, et cetera, all of that has increased.
Insurance.
So that's putting a pinch on a lot of landlords that's out there. We're fortunate from the standpoint we have very little debt on our portfolio, so but we've seen that happen across the board. People who were able to pay consistently, some of them were struggling at this moment in time.
Yeah.
Oh, Jay, I'm going to move to the Nevada border because California is trying to impose a $50 an hour minimum wage.
I saw that.
So I'm going to have my kids drive across the border and work at McDonald's at $50 an hour while I'm in Nevada.
Wow.
And,
exactly.
let them get there.
Your whole team's getting a raise, huh?
Exactly. So one of the things I want to comment about, Jay, too, you mentioned a little bit when you talked about inflation and people thinking interest rates are going to go down. 35% of inflation figures are based on the housing. So the only way inflation is going to go down is if housing goes down. So, and and interest rates are going to go down if inflation goes down. So if you want interest rates to go down, the only way it's going to happen really is if housing goes down, because housing can't keep going up because that's inflationary and
Right.
part of inflation, which only going to drop the rates when that gets back down. That's one thing I think people who are praying for rates to come down realize that it's somewhat correlated. Part of it's correlated to housing.
Absolutely. Good talking points, guys. Trying to get through some of these graphs here. So this one I thought was just interesting, just to catch up on where the next slide is going to go into more details with the 50 different major sectors across the U.S. of where, the year-over-year growth is versus the growth that's not growing, and the cities that you see right there that are in gray with the minus sign are, New Orleans and like probably Austin, Texas, and other places like that. So the top 10, I'm not surprised by some of these, but I am kind of surprised by the bottom 10 on a couple of them as well. I thought Nashville was a place that was growing real well, but obviously by this chart, it looks like it has some low appreciation there versus Hartford, Connecticut, which is 13.6.
Which, I'll be honest, being from New England, Connecticut's kind of had lost a lot of businesses, so that surprises me.
Yeah.
On that side. Anybody
else see any surprises on there?
Do you know, put you under the gun here, Justin? Is this? Did you say is this 2023 or?
I should have specified that. Thanks for saying that. This is all the way up through December of 2023. This doesn't include January, February data. So that's how far the report is updated through there. So thanks for saying that.
And the interesting thing, though, back to what Jay said, is, he brought up the good point of salaries aren't keeping up. While Nashville's booming, it's still, I don't think, the wage base there is caught up or, as high as it is. And you look at those other higher home price appreciation areas. Now, San Diego has the highest housing, I think, in the country.
Yeah.
Connecticut's expensive. Rhode Island's expensive. Cincinnati's starting to pick up. Miami's expensive. Detroit and Cleveland aren't. But you look at most of those cities, and it's where high wage earning growth. And then at the bottom, some of those I think are also getting hit, the Texas ones, because of the insurance and taxes. I mean, those areas are just getting crushed.
Well, Austin was appreciating unbelievably. I'm just wondering where they've already had their huge run up, and now they're over that crest, and things are starting to pull back in some of these.
That's what I'm wondering too. Same with some of the on the first chart, list there, where maybe some of those northeastern states took a big hit, and now they've rebounded.
I'm surprised Boise's not on that list.
That's a good point.
Oh yeah,
it's been a tremendous run up in Boise.
It may have been number 11.
Well, they're actually, I think they're down at the bottom now because they hit the peak. And I was speaking to somebody the other day who bought a really expensive property to use as a rental, and now everything's gotten expensive, and they're probably 20% underwater on that property.
Oh wow. Well, maybe it's number 40 then, or 51. Maybe it was the 51st area. Portland's up there. I don't know how close that is to Portland, but my reference point to when you get to the West Coast is not very good. So if I'm off by 2 states, that's shame on me for geography. I didn't learn any geography when I was younger.
Just know New Mexico is a state and not part of Mexico.
Oh, there you go.
Thank you. Finally, somebody clarified that for me.
Who was it? Somebody that worked for, I think, DHS or something, or, immigration, did not know that. So
that's not good. That's not good at all. All right. I want to get more into the commercial side of this stuff after this article. So I just happened to see this today, and it says the chief economist for the Mortgage Bankers Association, just saying how he predicts an economic downturn for the U.S. Amid all the challenges and decelerating inflation. And I just thought that was interesting. It's Globest, GLOBEST.com. That's an article that I found there, just so you guys know where it was. But it actually came out a couple days ago, and just thought that was interesting that they said that, and didn't know if you guys had a take on what you think the economy is going to be like this in 2024.
Well, if gas is any reflection, we've had a 45-cent increase in the last 10 days, all right, in our state. And it's like, okay, why?
Yeah.
And obviously everything gets transported takes gas.
It's true.
So,
I'll let
So
you
I
go,
don't know.
Jamie.
Yeah, the thing that comes to mind, I was listening to a podcast recently from Ken McElroy. He's a big real estate investor. They were reviewing a lot of the data on specifically on layoffs and how, obviously there's an election coming up. So generally speaking, things are going to look a little rosy in a lot across a lot of headlines.
Yeah.
But they were saying that they were listing all the companies that have been laying large numbers of people off, and that the balance of power is actually starting to shift back to the employer when in relation to employee and employer, meaning, during COVID and the ensuing years, you could work from home and there was a lot of flexibility. You could live anywhere. People were working 2 jobs, but now companies are calling people back to the office, not across the board. This is very case by case and nuanced geographically, but because the revenues they're not making as much money in general, the revenues are down. Calling people back to the office is a good way to lay people off and kind of weed people out and say, well, you chose not to come back. So I know that's just a sort of anecdotal broad brush statement, but it did sound like if you dig into the data with regard to layoffs from for some big name companies, that it's not looking so great.
Okay.
So and I also did see very recently that I guess yesterday the inflation rate ticked back up. So in general, it's come down, but I think it ticked back up. So it's pretty nuanced when you dig into the data.
It's funny, Jamie, you mentioned like the jobs. So things that, you ask people is when you look at the jobs data, what type of jobs are being added and lost? It's a lot of the white collar jobs. And interesting, you mentioned to come back to work, because I think I know the name of company, but I don't want to name them. We're forcing people back to work, but they shut down all those local offices. So like I was working in the LA office. Well, we shut down our LA office. So the closest office now is in San Francisco. Well, of course, the person isn't going to commute to San Francisco. So it's forcing them to resign. So regarding the economy and kind of the downturn, so I have a wife who's 100 times smarter than me, which isn't hard, who also, she works for International Monetary Fund, IMF, and she sees economic data and works in that all day long. And, when I ask her, her opinion on things, a lot of countries outside the US are still having significant issues with inflation. And, getting it down from where it was from 8 to 4%, that was kind of easy. That's like somebody, analogy you use, somebody who's extremely overweight to lose the first 25 pounds, but to lose those last 10 is going to be painful. And the government isn't doing anything to absorb that pain. So it's basically eventually the thought process is, yes, it will cause us to go into some type of recession, because banks are not lending money and small businesses need liquidity and it's not there. So what's the most expensive thing for any business? Staff and labor. So you're going to start seeing more of those jobs. But as Jay and Jamie mentioned, we're in an election year, so it'll be interesting how data's spun.
But I do agree that the government should help me lose weight. I think that's what you were saying, right, Chris?
There is there's some new drugs out there actually that can help you do that. And
just with a prick of a pen.
Justin, you made fun of me for having no comment. Now I've got comments. So be careful what you ask for.
Well,
the water faucet is open.
I'm just going to say we're going to be told that everything is going to be rosy. All right, just be prepared for that. So don't read all the don't absorb all the headlines as how it's being told. Look at the data.
I'm just going to start buying money printing presses, and everything will just be fine, because I think that's the solution to all of our problems is to print more money. So.
I'm not even going to say anything on that one. I'll get in trouble.
You're getting in trouble here. There's nobody listening. There's nobody listening. Just
nobody listening.
You guys are in the Midwest. I did read an article yesterday about a guy who had a fund that basically you invested in the cattle. So you bought like a share in a cattle, and he raised like $125 million for people giving him money to invest in cattle, which blows my mind. But somehow 120 of it disappeared. There's
Did you
120
ever get?
million disappeared. And I'm sitting there thinking, okay, how do you lose 120 million? But not
I
only
put it
that,
in the bank, but then I
yeah, but not only that, if you did, why are you still in the country?
yeah.
You know,
Right. You should have gone to New Mexico.
Google
or
search
out of the country,
Google
right?
search extradition. What
Yeah.
countries are available?
Hey, I grew up on a farm with cattle, so I know
Oh,
how
man.
that game goes.
Jay Redding the cow tipper. There we
There
go.
you go.
All right. How empty office space became the new boogeyman on Wall Street. That was just a funny headline that I saw. And the kind of blurb on that was that the CRE market is experiencing obviously a ton of stress from the empty office buildings. We've touched on that a little bit. Bad loans, high interest rates, causing concerns for banks and lenders. And so I just want to kind of switch gears to more or less the commercial topics in general and office space. I've read some other articles that the office space guys are trying to get really creative and convert these things to like luxury apartments and stuff, which makes sense, but it seems like an extra architecture nightmare. And I think Chris and I talked about that on the episode that Chris was on earlier this year on our season 6.
Yeah, I think Chris is going to have the most, no offense, Jay or Justin,
No, I
but to
agree.
offer here.
That's why he's on the
But
show.
but I do think that that's way easier said than done.
Yeah, not every office building is conducive to putting into apartments. I'm sure Chris would attest to that.
Yes, because a bedroom is lighting, an office building square. You don't have enough power and you don't have enough water. So start with that. But my main question is on this article: is boogeyman spelled correctly?
Boogeyman? I don't know.
I
thought there were two
It
O's.
seems like it is, but I am not the
That
best
looks like
speller.
it is.
boogeyman to me.
Someone say Siri. Look it up.
I think it is spelled correctly, but
Man,
I don't
You
know.
would think the article is from CNN, so we sure hope that
Who
there's
knows?
15 editors that looked over
It is.
this, or maybe it was a bot that looked it over for spell
I-
check and Grammarly.
you know, the other thing I'll just briefly touch base on commercial, and I'm curious to get your opinion. And you're starting to see more articles come out that they may have underestimated the losses on commercial,
Mhm.
and which a bank underestimate their losses. Oh man, that would never happen. So
Never has happened before, has
Yeah.
it?
I'm curious to hear, your thoughts on that, because that's something that I've recently seen a bunch of articles starting to come out. Housing Wire and Kobesi Report and some of these other ones are starting to talk about that. So just curious if you guys have heard the same.
I think you're spot on. I don't think people know how dire the commercial space is right now. And I think the banks have been feeling it, and I think they're really feeling it right now.
I just
That's
think
just
it's
from
just
what I'm
getting
reading.
started. I think it's just getting started.
Jamie?
yeah. Well, I mean, a couple of things. One, commercial is a very broad, it really depends what we're talking about. And I know this particular article is
Yeah.
office space. So office is absolutely in the crosshairs, if you will.
Yeah.
But there are other elements within the commercial real estate space that I think are not hurting at all and likely won't be. But yeah, I know. I mean, you can include multifamily in commercial when it comes to depending on how you define it. But I know
That's
in
true.
the multifamily space, a lot of the loans were going to be coming due this year. Chris can probably speak to that some.
Yeah.
But so yeah, these like 5-year loans, where the end of the term was going to be coming due in 2024, and the NOI is the property value is directly related to the NOI. So the property value has come down, and you can't refinance out of that loan if you're the owner of the property. So that does put lenders in a tough spot. Yeah, I agree. In general, we're going to see some real pain, but I think it's nuanced across the specific industry within commercial real estate as well as geographically. So the phrase "it depends" doesn't sell real well, but it
Yeah.
really does depend on what we're talking about specifically.
I was going to say two things I can add to
Go
that.
ahead.
Interesting, outside of office, I was speaking to an attorney. Self-storage is starting to really take a beating because, again, people's credit cards are racking up stuff. They don't have that money, or they're missing nose. And then the other thing I'll just mention about multifamily, like you mentioned, Jamie, and people need to realize this with any asset, is you might invest in a multifamily building that's doing really well. But if the two buildings next door to you all of a sudden are in trouble and they sell and they're selling at an 8 cap and you're forecasting a 6, and you get an appraisal done, what do you think your cap rate's going to be? It's going to be at 8. So it devalues your property significantly. So even though you might be cash flowing in that investment, there's no exit. So something to consider.
Right.
Yeah, I think there's another factor in here, and Chris, Jamie, certainly jump in. A lot of these syndications, particularly in multifamily, have been the darlings over the last few years. And obviously, in many of these places, rents are starting to pull back. As we had talked about, the cost of rehabbing has increased, and their NOI is not there. And now it puts the syndicators into a tough situation. They're either going to have to do a capital call, which will dilute your ownership interest, or hopefully they've got enough cash in reserve to maybe pay down debt. If they don't, and their debt service coverage ratio they're not being able to meet their debt service coverage ratio on the new loans when they adjust, and it puts them in a really, really difficult situation. Now, not all of them are that way, but there's a number of them that took adjustable rate mortgages underneath that's biting, and we're just seeing the front end of that starting to come right now.
Yeah.
Or one last thing, behind door number 3, they start a debt fund to support that shortfall. And then
there you go.
Yeah,
that's right. You didn't think about that.
Hire up that capital stack. So instead of getting it from investors, they're bringing in money to make that shortfall.
Where are you in the capital stack? Right.
Yes, critically important.
All right. So this was kind of cool. They're talking about cranes in the major cities and how many buildings have been going up or have not been going up. I thought this was kind of cool stat. I never paid attention to it because commercial isn't my space, but Chris and the rest of you guys probably agree with this, but they were just pointing out, hey, Chicago only had one major project going last year, and a lot of them had 0. Dallas, Fort Worth had 8. So I guess that makes sense because I heard of a boom that was happening in Dallas, I feel like the last 2 years. And so I guess that doesn't surprise me, but it's just interesting to see not a lot of major offices were trying to be built in last year.
Chicago, there was a foreclosure in an office building that 5 years ago, traded at like 39 million. It just sold for 4 million.
Oh God.
Wow. Ouch.
This graph here is a little small. I'm sorry. Go ahead.
No, go ahead.
I was just gonna say this graph is a little small, but it's a continuation of what we just saw from the main graph, which is just showing those cities and how the amount of buildings has been declining in those markets that you can see there.
What's scary that I see for this is, and again, I'm in the Washington, D.C. area, and that's the federal government, every lobbyist, all the big law firms, a lot of the Raytheons and all the defense contractors are all in this market and so forth. And to see those declines, even in that market, that's saying something about kind of some of the dire. And then you look at Manhattan, the financial center of the country.
Yeah.
San Francisco's got its own problems. But you look at all of this, and it's like, wow.
Yeah. This is just from, I have to get close here, Q1 of 2020 is where it's showing the left side of the graph to into 2023. Maybe you guys can see it, but it's very small for me.
I was gonna say, it looks like how the scribbles when I started to learn how to write.
Yeah, it's like ancient Egyptian language.
Yeah,
It looks
there you go.
hieroglyphics.
How'd you get Chris's signature on there for Chicago?
It's partially mine too. All right, so the little blurb that I saw off of this graph was the reduction in office construction has economic implications. And these are things that I really didn't think of till I read it. And I thought it was kind of interesting to jot those down. And they said, one, downtown businesses generate less than sales tax revenue due to fewer workers and lower CRE values, shift the property tax burden to homeowners. The lack of construction hampers the vibrancy of neighborhoods and can hinder efforts to attract tenants and bring employees back to the offices. So we've kind of touched on a little bit of this already, but that's kind of interesting how I saw that. Any of the comments on that stuff?
Makes sense.
Makes sense.
All right. Won't beat that up too much longer. Okay, let's get to the fun stuff. This is what I like to talk about because honestly, we all do this in a similar way, but slightly different and on different scales. And in general, this is probably the most common question for somebody that gets into real estate, really, because they traditionally run out of their own money pretty quickly, unless they're, a third generation, wealthy kid, that their father must have been like Rockefeller or something. But if your father or grandfather wasn't Rockefeller, you're probably out there raising private capital to go after real estate transactions. And this works in any kind of real estate world that you might be in, whether it's traditional, whether it's multifamily, whether it's getting an office building, whether it's trying to buy the single family house down the street. Most of us are doing note funds, and so we're all raising private capital. So I guess the topic of conversation is raising capital, and kind of want to go down the list here, and we'll start with Jay and kind of go Jamie and then Chris on what is kind of what I want to say. What's the one way that you raise private capital for what you do, and why you're raising it?
Sure. I'm probably the baby of this group. All right. We basically use the friends and families approach. So essentially, we are raising capital with people that we already have a relationship with and that we know. And essentially, we do strictly debt funding. We do not provide any type of equity. So when we go and talk with a private investor, we're sharing with them for how their money is secured. All right. And this would be whether we are doing a real estate deal. Obviously, they would be secured by having a note and a mortgage in our state. And if it's a note, all right, we're pledging a performing note as collateral, then we do that via hypothecation. That's what we do. And that's a topic for a whole nother discussion later on down the road. But we essentially pledge the note as the collateral, and we do it 1-to-1. So one investor to one note, one investor to one real estate deal. We do not pool money, so we're not to the note fund, or I should say to the fund deal. We're pooling. So that's what we do.
One capital partner and one asset, 1-to-1.
Correct, right? And it's strictly a debt relationship.
Jamie?
Yeah, I mean, I think the first thing I'll say is my personal opinion is you should gain knowledge at asset management or know what you're doing before you go out and raise capital, because there are plenty of gurus out there teaching how to go get capital when the person doesn't even know what the asset class is or how to do real estate or note investing. But with that caveat out of the way, completely agree. If you're going to scale, even if you have lots of money, it probably doesn't make sense to use all of your own money or only your own money in your business and your investing for your investing strategy. So what I've done, quite honestly, Chris was a mentor for me when I got into the note space. I've certainly used bank money for our rentals as well, but that's not really raising capital. I've I got to the point where I wanted to scale my note investing business, I initially did joint ventures. So the 1-to-1, like Jay is talking about, although not with debt, where we'd buy the asset together. So you have a funding partner, and then I was the day-to-day manager of that asset. So I did a decent number of joint ventures, and then I also did hypothecations as well. So paying a specific return, and hopefully I make more than that. Hopefully the asset spits out more than that, and I make some money there. So no matter what, you're going to run out of your own capital, or at least the amount of capital that you've set aside to do your investing. So I think joint venturing is a decent way to go. Hypothecations is a good way to go. And then we've done the 2 note funds. My first note fund is winding down this year, and Chris and I started that fund together. It's a non-performing note fund that's closed for capital raising. My other fund is called the Integrity Income Fund. That is open for it's an income fund, so it's a kind of a slow, boring cash flow play, for the investor standpoint. But and in that fund, we purchase performing and reperforming first lien mortgage notes. So definitely smaller scale than Chris's fund. Chris, take it away.
Yep. So I want to echo what you've all said about, learning the business, start small, and build a track record for yourself.
Yeah.
That's really the most important thing before you even consider a fund. I see a lot of people now just saying, hey, I want to go a fund model because I can raise capital. And let me tell you, raising capital today is 10 times harder than it was 3 years ago, probably actually even harder than that. And for us, we went the Regulation A+ route, which lets us get investors from both accredited and non-accredited. So, it's funny you mentioned, like, I love the acronyms that our investors. So we've got GOATs, Henrys, and Dinks. Goats are getting old and tired. Henrys are high earning, not rich yet, and Dinks are dual income, no kids.
No kids. There you go.
But that's the benefit of our offering that we had is it's $5,000 minimum. But we also have over 500 investors in our fund, and if you are not scaled or staffed or organized to manage 500 investors to get 500 tax forms out, 500 distributions out every month, and then answering the phones for all the questions that people have, you're going to get overwhelmed and you're not going to be able to actually focus on buying assets or managing assets. And you're just going to essentially become a call center. So really important to understand, like I mentioned, learn the business and then build that track.
All good points there. So our fund is kind of a blend of what everybody said. Ours is much smaller than Chris's. We have a Regulation D 506B, so we can take accredited, but just a few non-accredited investors. So we mainly try to attract the accredited investor because we have unlimited amounts of those. And then we're trying to buy performing loans with our fund. So ours is boring like Jamie's. We're just steady Eddie. We're not taking any risks like Chris. We're not going to take the plunge. No, Chris doesn't take risks. He takes calculated risks. Okay.
Very calculated risks.
Yeah.
Yes.
So yeah, and I started off the same way, like Jay and Jamie mentioned. And I know Chris has done that too, where you have the one-to-one relationship, and that's kind of how you got to start out, right? You got to show proof of concept. Now, a lot of people have a lot of money when they get into this business, but it is good to have Chris said a track record. And so a track record can be as simple as I bought this deal and this was the outcome. This is what I paid for. This is what I went through the process. And that is a track record. I know it's one asset, but it is a track record. You have to start somewhere. And that's what it takes to raise capital. So from the lowest level to, a more complex situation that Chris has with an A+ fund, it all can be done, but it becomes a full-time job. You're not a passive investor anymore. When you sit on this side of the microphone, you are an active investor, and it is a full-time job for all of us. This is what we do for a living. This is all we do. Recently, and I'm not sure how Chris did this. He had a full-time job and he was trying to build a fund as well. So,
and 200 plus assets.
Yeah. I don't know how you did that.
Yeah.
I look back now, I'm like, that was just why, young, dumb, and stupid, I guess. 44 years old, so with that time, still never learned.
Oh, you're so far ahead. I didn't even start real estate investing until I was 45. So
nice. You're like so
Colonel
Sanders.
For everybody. There's hope for everybody.
So Jay, it's interesting. You just hit on such a great point. I didn't start investing in real estate until I was like 39. You were in mid 40s. Jamie was a Rothschild back, he changed his name. So he's always been in real estate. I'm curious, Justin, Jamie, when you guys got into
2010 is when we bought our first rental.
Yeah.
So, but truly actively for about 10 years now.
So he sold his first rental in 2011 then.
No, still own it. Actually, I have the same.
That's doing well.
I have the same tenant in that rental.
That's unbelievable.
Advertising Craigslist, and he's just divorced guy. He's the best tenant. The numbers aren't amazing, but it is really passive as far as
appreciation must be off the charts.
Yeah, exactly. Yeah. But
he bought in 2006 and sold in 2011.
Genius.
Ask me how I lost money. All right. I got started around the same time most of you guys did. So I really was a full-time investor at the end of 2015 is when I became a full-time investor for real estate. And then Notes kind of was about a year later after that. So I haven't been on it too long, but I've had enough to where I've got, maybe 1,000 or so deals under my belt already that I've bought and sold for myself and or for many other people. So
well, I do think just it's important. I know we're almost out of time, but just to think through whether you actually want to, certainly go the fund route, for anyone listening. It's not, as we've already alluded to, it's not passive. And when you get that you sell off, Jay, if you're doing 1-to-1, you sell off the asset, you can return that money to your investor. There may not be pressure to put that money back to work. When you're running a fund, all of a sudden you sell off a bunch of assets. You've got, I don't know, $2 million. You got to put that to work. There's a lot of pressure to put that to work, not just to report to your investors, but actually the asset management side becomes that much more challenging as well. So there's a lot to it. So it's not a small undertaking.
And I've raised too much capital. Said no one. So as you think of raising capital, it is hard, and you're never going to hear anyone bragging that, oh my God, I raised too much capital. Every month over month, they're like, even if they hit their goals, like, oh man, I wanted to raise more. I wanted to raise more. If you put the truth serum on every person raising capital, that would be what they would tell you.
Because they're greedy. Fund managers are greedy.
The challenge is always money or deals. Okay. I find myself, okay, I've got people that say, hey, we've invested with you. We'd like to invest some more. And it's like, okay, I'm out trying to find deals, finding the deals that fits the money that they've got. That's always the game. All right. From my standpoint.
I think that's true at any level, whether you're, at the 1-to-1 level, or if you're at, what Chris is doing A+ level is managing that expectation. And it's a great way to put it, Jay. It's a two-legged monster, really. It's like capital and assets. It's like if they're totally out of balance, then you got a problem.
Like, I'll use an example. Last March, we were sitting on cash, and it's like, man, trying to get this out the door. Now you asked me over the last 3 months, I'm like, the deals just keep flowing, and I'm like, oh my God, like I can't. This is a great deal, but it's like, sorry, you got to turn it down, type of thing, because literally tens of millions of dollars of deals that are decent deals flowing through a lot of times. And it's like, okay, you got to, which is a benefit. You get to cherry pick those deals that you want. But it's like you said, it's always that balance of, it's never that perfect symmetry of having just the right amount of money and the right amount of deals. It's always heavy one way there. Yep.
Never that utopia.
Like the seesaw.
Yeah.
Well, just remember, Chris, if you've got so many deals you don't know what to do with, you got a couple other people here that would be willing to take a look at those.
Oh no, I know.
Then we'll end up trying to resell them back to Chris.
I feel like
did I sell you that asset?
Did I see that? Yeah.
I feel like I'm on the seesaw with Jamie, and he's the kid that would get off when you're up high and make him swing back down to the ground. Come on, don't tell me you've never done that.
Yeah, I definitely
I'm guilty.
I'm going to take a question here. Up on the screen. Sorry, Chris, you disappeared again.
That's okay.
Our friend here asked, how do we get involved to be the bank? Minimum investment amount needed. So this is kind of like a general question on getting into the note business. So I guess to answer your question, we'll go run down the list, is more or less, are you wanting to be like a note portfolio manager of your own portfolio, or are you looking to invest in something to give you a passive income? And I think the answer from my perspective is, if you're trying to invest in something, especially in our note business, I say you want to have at least about 40 to 50,000 to at least invest in one asset. And obviously I wouldn't be spending the entire 40 to 50,000. I'd leave some in reserve just so you can get used to the nuances of it. But like with Chris's fund, I think, what's your minimum? 2,000, you said? 5,000. So for $5,000, you can just have a passive income from a small investment like that. My minimum is 30,000. I don't know what Jamie's is.
25,000.
25. And then Jay, obviously it's 1-to-1, so it kind of depends on the asset, but I imagine it's probably 30 plus.
Yeah, but we're at least 20,000. 20,
and my fund is,
it's hard to do anything less than that with what we do.
Okay.
Mine's for accredited investors only, just to clarify.
Thank you.
But
does anybody else have anything to add with the question?
I mean, you can buy smaller dollar loans, but then it's just higher risk because it might be land or something along those lines that you might be getting into. And usually what we find with most investors is it's kind of like, the little kid trying to put all the little blocks in the right space where you're trying to help them, they won't let you. Similar to note investing, where people will go try and do it and realize, great, I'm making 8%. I can give Jamie, Jay, Justin, or myself, the money and then sleep at night and get the same return. Because also we do have benefit of buying more in bulk compared to
Yep.
people buying one off. So that's something to consider, is what is the best use of your time.
That I think is what a lot of people are realizing now. People that, when I first got into the note business a while back, I would always try to educate them and kind of hold their hand and help them through the note investing journey, even though they didn't have, the same education I did. I felt like that's what I should be doing. And I realized I'm not doing myself a favor, because I'm not making any sort of fee off of that. And nor am I not doing them a favor, because they're getting frustrated and they're kind of going, I got to wait for Justin to get an answer. So it's like, if you're at that level to where you don't have the time, like you guys are saying, to put forth to learn and educate and do this to be the active guy, then you just really need to be the passive investor for now. And guess what? We need each other. We need each other. We're the operators. We do this every day. So by all means, it's benefits you, even if you start off this way, and then eventually you get to a level to maybe where maybe I'm at, or Jay or Jamie or Chris, all that's okay. It just depends on really how much time do you have to dedicate towards this.
Same thing with buying
I would. Oh, go ahead. I'm sorry.
I said it's the same thing like buying stocks. Like, okay, am I going to monitor this every day to figure out what's going on and put stop orders and all this other stuff in?
Yeah.
Like, I try it for a little while and realize, okay, this ain't for me. I don't have the time. And it's like, okay, I'll go, work with someone else who can manage a portfolio, or again, invest it in a fund, which, same thing, as a diverse portfolio, and you don't have to worry about it. Just check your statements every month.
I was just going to say, if you are wanting to put your toe in the water and actually managing something, there are such a thing as what's called tails out there, and that is essentially a note that's almost finished up on its. Say it's got maybe 20 payments left or something like that, and it was a 240-month note, or 180-month, or maybe even a 360. It's at the very tail end, and now the discount's not going to be very much on there, but it's a great way to put your toe in the water, get the feel for how to manage the note, and how to manage it, and kind of get yourself started. And you can typically find those from time to time at a very, very nominal price to get into it.
Yeah. Another piece of advice is, if you really do want to get in as a active investor, rather, maybe buy a partial for $5,000 to $10,000 if you don't have $50,000 to put to work. But the reality is, you're going to need some time to educate yourself and partner up with someone who knows what they're doing, and maybe even work for someone who needs help with portfolio management or something like that. But a partial or hypothecation is another way to get in for potentially less capital.
There's no better way to learn than to be tethered to someone that's done hundreds or thousands of transactions. And also, when they have skin in the game too, it's a great way to learn and not have to pay, for let's say university education, for your craft especially. So
just be careful who you partner with. Google them.
And like Chris said, I think Chris said earlier, the due diligence on the sponsor or the investing partner or whatever, you have to do that. We have to do that for our investors, and vice versa. The investor should be doing that to us, to any of us on the camera.
Yeah, because you don't want to be. I've heard the the joke that a joint venture starts out with one partner has the capital, the other partner has the experience, and then they switch places at the end. You don't want that to happen.
I mean, when you look at some of these, like, syndications that went under, you Google a sponsor and it's like, okay, they had no career in real estate and their asset managements are VAs. There's, a well-known NPL note quote guru who, would teach and do JVs with people. And, unfortunately the money only went, one way, never made its back. And actually, from what I hear, that person's actually back, because somebody emailed me the other day and said, oh, I've been working with this person who's really been teaching me a lot. And, I had also had a note with them, but, I haven't seen any of the funds or anything come back and so forth. And I was like, oh, is it this person? Like, how would you know that? And I'm like, did you Google the person before you gave them money? And she's like, no. And I'm like, well, you'll know why now.
Yeah, I think that's one of the, with note investing in general, that's one of the great things about it, is that there's a low barrier to entry, right? So anybody can learn this. There's not a lot of licensing or compliance hurdles necessarily to get into this, but that's also the bad thing about note investing is there's a low barrier to entry. So, it can attract people who maybe don't have the same ethics or morals that we do.
Just Google the person. First thing you should do.
I agree.
It's such a small community that we're in. We're in a niche market, and we all know each other. We're all four of us up here. We I guess we're actually in competition with each other, but we're really not, because it's so vast with as many assets that are out there, as many investor opportunities. So we all just really just collaborate and stuff. But I have people that talk with me and they're like, yeah, blah, blah. I was in Chris Seveney's fund last year or whatever, or Jamie's fund, or I work with Jay. And I'm like, that's an awesome guy. Stick with him. I vouch for him. That's a great person to do business with. And that's what I also think.
I'm in Chris's fund right now, FYI.
Jamie, is Justin challenging me? Is that a challenge?
I wouldn't necessarily recommend it.
Well, the other thing here is that what we are specifically looking for our portfolio, our portfolio is all different. How we invest is all different. So one note that would be good for me may not fit for what Jamie needs or what Justin needs. Now, Chris will take them all, but that's besides the point now.
But I mean, as I mentioned earlier, the mortgage is a $13 trillion industry, and we all don't just buy NPLs; we buy performing loans. Yeah. And if there's $500 billion in non-performing loans, plus all, and that doesn't probably even include the seller financing stuff and some of this other stuff that you see out there. Yeah. So if we're buying, each one of us is buying even a few $1 million a year, we're not even like a grain of sand on the beach. Yeah. So there is so much opportunity. Yeah. That's out there.
That's a good way to put it. If you guys have any deals out there, portfolios or single assets, just go ahead and scan this QR code. If we're not a fit for them, obviously there's 3 other guys on here that can be a fit for them: land contract, contract for deeds, note mortgages, note and deed to trust, lease options, you name it. I typically buy first liens. Maybe some of the other guys on here might buy seconds, but by all means, we're all connected together. We try to pass deals to each other, like we mentioned before, when we can't fund them ourselves, or if they don't fit our wheelhouse, like Jay was saying. So send those to us. The next time we're going to have a online live stream meeting here is going to be March 13th, Wednesday, from 6 to 7 p.m. Eastern time. My company is American Note Buyers. We got Jamie with BIFI and Integrity Fund. Is that the one that's still open?
Integrity Income Fund. Yep.
Fund. We got Jay there at Cassidy Investment Group. We got Chris with Seveney, and we don't say CWS, right? We just say Seveney Investments.
Seveney is our brand. Yep.
Seveney. Yeah. So to wind down the show today, guys, and by the way, thanks for jumping on today and for wanting to continue doing this going forward. Does anybody have any closing thoughts? And I guess we can start with Jay and work down there.
If you want to get into note investing, the first thing that you have to do is decide whether you want to be active or whether you want to be passive. It's not a right or wrong question. It's what fits you for what your situation is. And that's the first decision you really need to decide for yourself. So that would be my 2 bits.
Jamie?
Yeah, I think that's great advice. We all have different niches within this niche, and so feel free to reach out. I've got BIFI loan servicing if you're an active note investor. If you want a servicing company that's was built by investors for investors, and then I have the Integrity Income Fund, which is for accredited passive investors. But and like Chris said, I'm there's no better way to spend Valentine's than with you guys.
So, I will say, if you are a note investor, use a servicer. That's kind of rule number 1. The thing I'll mention, just in final thoughts, is a lot of people are still out there trying to chase rentals and all these other asset classes and so forth. I don't think people realize, like, when economies start to settle or get a little disrupted, lending and note investing is like the place you want to be. Because you're buying loans today that the properties have significant equity in. It's not like they're crashing values where you could potentially get wiped out or lose a significant amount. Of course, you still can, but the risk profile to me is significantly different than paying market value for a rental property today that you're going to have to put 30-40% down, which is a lot of capital, and then finance the rest. You can get high single digit, low double digit yields in note investing. You're not getting that in any other type of real estate today. So I would tell people, if you're looking for something to get into, take a hard look at note investing.
Absolutely. Great advice, everyone. Thanks, guys, for being on the show today. Next time, we're probably going to have some case studies. We'll dive a little bit more specific, get everybody feedback on maybe a case study that one of us does that we're going to share. We can dive into it deeper. And until March, happy Valentine's Day, everybody, and we'll see you guys in March.
Thank you. And Jamie, your makeup looks great today, by the way.